So one thing comes to my mind, you say you can do the cost seg after exiting the property. So how would that work? Let's say you exit the property, you say, okay, I'm going to do kind of retro thing and I wanted to do the cost seg now because I'm going to offset some of the capital gains. And here I bought the same property from you and I'm trying to do the cost seg first year so I can take the most tax benefits first year. Is the same property being depreciated twice? Can you shed some light on that? How does that work?
Yeah, so when you've exited the property, you've already depreciated it. What we're doing is changing the method of accounting to treat the personal property as personal property and the structural property as structural. If you leave it as a default, it's all going to be structural. It's all going to be that 27.5-year or 39-year property. So when I am going back, I sold a property, I'm changing my method of accounting to treat it as though I sold personal property and structural property. And if I do that, I might save myself some tax because personal property, if I've depreciated it, has no value and it's beyond its useful life. It's a zero, it's capital gains, as opposed to recapture. And at a big enough number, that starts to really add up. And so in the case I mentioned, it was, close to $80,000. It's actually, right around $80,000. So I would rather do that. It cost me 10 grand or whatever it is to save 70 or save 80. I'll take that action.